Moving averages are one of the most widely used technical indicators amongst Forex traders, as they can help identify trend direction and may indicate buy and sell signals, so it is both useful and important to master how to use them in your trading strategy pretty early on. That's why in this video we are going to spend a little bit of time talking through simple moving averages, moving average convergence and divergence, and the stochastic oscillator. Now please remember that CFD and spread betting are high risk and your capital is at risk. Therefore, as with all technical indicators, while at times they may be helpful technical analysis tools, they are not perfect tools for establishing trends, especially in times of highly volatile market situations. A moving average is a method of calculating the average value of an asset's price over a period of time. Now, simple moving averages take the average of the closing prices seen during a fixed period of recent price action. For example, a 21-day simple moving average, which is a popular period amongst traders, will take the closing prices for the last 21 days and divide this total by 21. Now, popular moving averages used in Forex trading are the 21-day, which is around 1 month of price data, the 50 or 55-day simple moving average, the 100-day and the 200-day moving averages. Now, the idea behind the different time periods of the moving average is that they actually track different degrees of the trend. Now, the shorter the time period of the moving average, the quicker it reacts to changes in trend direction, whereas the longer the moving average, the greater its smoothing effect, which then results in fewer whipsaws or false signals. Just like trend lines, the upward or downward slope of a moving average can indicate the strength of a potential trend. Many traders like to use 3 moving averages for each currency pair, one for the short term, one for the medium term, and one for the long term. Now, the point of moving averages is the fact that they may indicate whether you are in an uptrend or in a downtrend, and can therefore offer some good trading signals by interacting with the prices or with each other. Now, commonly, if you're just using one moving average, for example the 21-day moving average, a typical buying signal could be when the price rises above the moving average, while a sell signal may be generated when the price closes below the moving average. When you're using 2 or more moving averages with different time periods, signals are given when they cross each other. If the short-term moving average, for example the 21-day or 50-day moving average, crosses above the long-term moving average, here for example the 100-day or 200-day, then you are in an uptrend and could indicate a buying signal. Conversely, if the short-term moving average goes under the long-term moving average, it's in a downtrend and it could indicate it's a sell signal. As discussed earlier, one of the most popular indicators, often used by investment banks, hedge funds and market makers as a key point of analysis, is the 200-day simple moving average. Now, its first use is as a support and/or resistance, while traders find that they can build entire strategies around the 200-day moving average. As we were discussing earlier, crossovers can be established when using 2 or more simple moving averages on a price chart. However, you can also use moving average convergence and divergence, also known as MACD, which can help identify crossovers between 2 exponential moving averages. Again, just like simple moving average, MACD is another way to study pricing data in order to help identify potential market trends. Now, the MACD displays the difference between a 26-period moving average and a 12-period moving average, while the signal line default setting is a 9-day exponential moving average. Now, some traders use this signal line as a trigger for buy and sell signals. For example, when the MACD line crosses above the signal line, it suggests the trend has turned up, and also vice versa. When the MACD line crosses below the signal line, then it suggests the trend has turned to the downside. Now, the 0 on the histogram suggests a turning point. When the lines start to move back to the middle, it's often an early indication of a MACD crossover, which is often interpreted by traders that the direction of the trend will soon shift, potentially creating your buy or sell signal. Another technical indicator that is used to help determine where a trend might be ending is the stochastic, which is similar to the RSI and can help identify when the market may be in overbought or oversold territory. Now, the stochastic is scaled, and when the stochastic lines are below 20, indicates that the market may be oversold and a possible buying opportunity. Conversely, when the stochastic lines are above 80, it is interpreted as the market being overbought and may be a possible selling opportunity. The key thing to remember here is that it is only when the stochastic levels break through those levels and come back on themselves again to break back through those levels that it is interpreted by the market as a possible buy or sell signal. It's important to remember that most moving averages are lagging technical indicators, which mean they tend to trail behind the current price in the fast-moving markets. Thus, in a highly volatile or non-trending market, trading signals using moving averages can have the tendency to generate faulty signals.